A very warm welcome to all of you in this very interesting fireside chat by CXOTV, where CEOs and MDs narrate the story and share the learnings and success of building a great brand. Today, we have got with us Mr. Vinod Keni, who is the co-founder and managing partner for Peach Tree Ventures and co-founder and managing partner for QI Ventures. So Vinod is a renowned figure in the industry with a successful career spanning venture capital. He has been a serial entrepreneur, and he's a renowned corporate finance professional. As an advisor and mentor, he has played a crucial role in guiding corporate VCs, family offices, VC funds, and many startups. So his extends across the entire life cycle of VC funds, from launch and fundraising to portfolio management and exits. So his extensive experience and strategic insights have solidified his position as a respected leader in the world of venture capital. So very warm welcome, Mr. Vinod, in this fireside chat.
Thank you, Amit. Appreciate it, and thank you for inviting me for this conversation.
Sure, sir. It's our pleasure. So let's start with the first question. We are seeing that more or less startup ecosystem in India or maybe across the world is undergoing a funding winter kind of scenario wherein funds are showing slow. The investors have become cautious, and valuations of many large startups, even unicorns, are going down. Okay. So, can you let us know what were the major factors that contributed to the funding boom? Because in 2021, 2020 and 21, we have seen a kind of funding boom. Okay. And then we are going through a funding winter. So what were the reasons? What were the major factors that contributed to the boom and now the winter kind of situation?
So, great question to start off the conversation, Amit. And, I think the boom was primarily fueled by the fact that there was a fair amount of, low interest capital available, right? Because cheap capital started getting pumped into the system. So that was one, where over a period of time, there had been this capital that started really getting into this asset class. I think the second one, which is actually a good development, was the fact that the venture ecosystem, the early stage angel as well as the early stage venture and even the growth stage venture ecosystem, especially in India, had started growing, and had started growing fairly significantly, which also meant that there was a fair amount of capital formation at the fund level that also happened here in India. And then there was also a fair amount of acknowledgement of this asset class amongst the HNIs and the family offices in India itself, which also contributed a fair amount of this money into these funds. So there was domestic capital that was being developed, though domestic capital in India is still not necessarily at that same level or stage at which institutional capital from overseas or even outside capital still keeps flowing into India. But domestic capital started really developing and started also coming into its own. And that actually also contributed a fair amount, right? The third was the fact that all these initiatives, Startup India, the SIDBI's Fund of Funds initiatives, a lot of those initiatives really then started highlighting the fact that there are opportunities in entrepreneurship. And especially not just at the tier 1 metros, but also in tier 2 towns as well, right? So I think there was a lot more of that awareness and a lot more people who started really going out and saying, let me go and start looking at building companies, right? Let me start looking at solutions for people. So I think that also in parallel started really taking off. And, I think when you actually have entrepreneurs who are really out there going out and building businesses, and there is also capital that's now starting to become available, you sort of have a happy marriage, right? So you essentially end up in a situation where there are these forces that are coming together to actually start creating a fairly large, vibrant ecosystem. Added to that was the fact that, there was overseas capital, there were overseas, investors who started really looking at India as well because of the growth opportunities in India, the fact that the Indian economy had been resilient and actually had started really growing, how the Indian economy reacted during the COVID pandemic, and the fact that we as a nation and as an economy continue to grow, and the demographics and all the other things also made this a fairly attractive market, right? So people started saying, let me start looking at India as an investment opportunity And for those who are already investing in India, this actually said, okay, can you actually start allocating more money to India? And that, I think, also added to this whole ecosystem as well, right? So capital was there. Entrepreneurs really started going out and really looking at building this out. Where I think there was a little bit of a mismatch was the fact that a lot of the entrepreneurs thought that the only way of building a business was through capital, right? Whereas if you historically look, most businesses that have been built over a long period of time, successful ones, very few of them have been backed by venture capital, right? I mean, a lot of them have bootstrapped the way to success as well. That was the only issue. But I think from that perspective, that boom was actually going to start to continue to be there. And that started really taking off, 2019, 2020, and really continued 21 and early part of 22 as well. And I think that was the impetus that sort of gave it the momentum to really get going. A lot of it was also, some of the initiatives that the government has actually taken as well, right? To actually start promoting some of this. And I think that aided that, the development of the local VC ecosystem, all of that actually helped. Coming back to the funding winter, which is what everybody keeps talking about. Look, I don't say it's a winter, right? Because these are normal investment cycles. A lot of these investment cycles sort of mirror how the economy sort of goes through its own set of cycles, right? So I'm sure if you've seen the historical trends, we usually end up having these cycles where investment drops, then it picks up again, it drops, it picks up again. Right? These are cycles that we're going to go through. And I think this is just another cycle that we're just going through. I think why it sort of became almost like a funding winter, or that, whole term started becoming more extensively used, was that over the last 2.5 years, there was so much capital that had come into the country, right? There's so much capital that had chased startups. You started seeing obscene valuations for companies, unicorns being born almost every day. And some of them had some really heady valuations. I think that sort of gave people the impression that, look, this is here to stay and this is going to continue. People who had been in the VC industry for a long time, people who had seen these cycles, people who had been through multiple fund cycles, they knew that there was at a point that this was actually going to start really stabilizing or starting to come to a point where it's going to start slowing down and really can't start coming down, right? I remember conversations that I had with some friends of mine from the industry in early 2022, where we said, look, we are telling our startups, and I was doing the same, there is money available, go out and raise more money than you need, because you may not necessarily be able to get that next year. We think that, it's come to a point where things are going to start slowing down, right? And we started sort of seeing that. And some of that was, the Fed in the US started talking about interest rate hikes. There were geopolitical issues with the whole Russia-Ukraine issue. There were commodity price challenges. There were supply chain challenges that still were getting resolved, but there's still challenges there. So the cost of capital and the risk appetite of the capital was also starting to change. And from that perspective, we said, look, this is now going to start coming to a point where people will definitely start slowing down. But I would say, for good companies, good entrepreneurs who are building scalable businesses, there's no dearth of capital, right? Because there was so much money that was raised in the last 3-4 years. There's so much dry powder that's available to actually deploy. The only thing is now, instead of being so reckless in the way people were investing, people have just become a little bit more cautious and saying, let me pay a little bit more attention to what should have been done, which was always the normal course. When we were investing, nobody would go and complete a deal in a day or a week. Right? It would take us a couple of weeks, a month, maybe 2 months. And that's the normal course of how venture capital and private equity deals have happened. And that's what it's now come to at this point.
Very good. So what we are seeing that investors are becoming cautious in how they spend their monies. Okay. So can you also let us understand what exactly are in the minds of the investors? What are the things that they are looking at, and how their sentiments play a role in fluctuation of startup valuations?
So look, we have always, the good VCs, the VCs that have been investing, any investor that's been investing for a while, there are three things that are really important to us, right? Especially at the early stage. One is, of course, people, the team, that makes really important. The market, how big or is the market growing? And then finally, the product or the solution that you're actually building for that particular market. These three become really important. Now, I think we are paying a lot more attention to team and people, which should have always been the case. But in some cases, people just got carried away by the fact that there was product and people started really chasing products, or at least a sector, right? EdTech, for example, during 2020 and 2021. So now we are paying a lot more attention to teams, to the domain expertise and the capabilities of the team in itself. the execution capabilities of the team in itself, because India is a very high friction economy, right? Building a business in India is much more harder than building a business, let's say, if you want to do it in the US. So from that perspective, what kind of execution capabilities do you really have to be able to really scale the business? And investors are also now spending a lot more time on looking at business models. How capital efficient can you be? Because look, cheap capital is not available anymore. So you don't necessarily have this, saying, okay, I'm just going to keep burning my way through till I get to a product market fit. Are you innovative enough to actually look at capital efficient models of building a product and taking it to the market? Can you get to a point where product market fit happens a lot more faster? Is there a way for you to actually be able to get to a situation where there's more pull in the market than push in the market? Can you do all of those? So we are now starting to, I have always done it, but I think most investors are now starting to spend a lot more time on that. They want to see visibility on the financial front as to when these companies can turn potentially profitable, when can they get to cash flow positive. And then also more importantly, what kind of capital do they need, to get to that point, right? Where it can start getting really self-sustaining. And is that capital that they really need realistic or unrealistic? So these are all, standard things that any of us as investors would have always done has now started coming back into the market, and people are starting to pay a lot more attention and being a lot more cautious. And they also realize that some bets that they had made earlier are not necessarily going to work out. So there is also a certain amount of skepticism about some of these growth projections that companies or entrepreneurs would make. So they're, essentially taking their own sweet time and actually evaluating those before they actually jump in.
So, if we look at the current market scenario, okay, so how do you think that means the startups can build a confidence among their investors? Okay. So what are the measures that you would suggest for the startups to build that kind of confidence? And can you also share some examples of tech startups or maybe general startups that have effectively communicated their growth vision and have actually nailed that art of building a confidence among their investors?
See, the relationship between the company or the startup and the investor are always going to be ones where the company or the entrepreneur wants to really build a sustainable business, but the investor also wants to be able to make money, right? See, end of the day, investors also have a commercial angle to it, and they also have a fiduciary responsibility, right? Because most venture funds or most private equity funds are third-party money, right? We go out and raise money from others, and we have a fiduciary responsibility to return that money back with a return that we are actually promised, which essentially means we have to be able to make money, right? So we look at all of them from that perspective. So I think it's very important for companies to really understand that perspective, that look, the investor and the investor is the one who's actually here to make a return. And from that perspective, the investor says, I'll do everything that I can in my capacity to help you get to that point where I can actually get a return on my investment. Whether it's an M&A, it's a secondary, whatever else it could be, for me to actually be able to get to that point. So I think it's really important for these entrepreneurs and the startups to actually start building those relationships up with the investors very early on, right? So which essentially means being very transparent, really going out and really having those conversations with investors on a frequent basis and telling them what's really going on with their business. What happens is, in a lot of cases, startups really think that the investor just gives them money and that's it, right? Let me just move on, let me go and do my thing. It's not. It's a marriage. And this is a marriage which is going to be long-term. And if both parties only work together, and it will the marriage be successful. And we have enough examples of companies where, investors have been very supportive, have actually gone through all the way to actually take them through. Classic example I'll give you, and it may not necessarily be a VC example, is the company Concord, which just went public today, right? They actually had an investor, and one of their investors was Rare Enterprises. Mr. Chunchunwala was an investor, and he'd invested in them in 2004 or 2006. But he had invested, by today's standards, he invested a small amount, and that investment has grown over this long time. Of course, this is way beyond the life cycle of any VC fund. But the fact that he had such a good relationship with the promoters and had been very supportive of all the things that the supporters went through in their initial days was also the reason why that marriage actually was so successful. And even now, even though the company has actually gone public, Rare Enterprises, the ones that actually had invested the vehicle for Mr. Chunchunwala, since publicly came out and said, look, we're not selling our equity as of yet. And that gives you that kind of confidence, saying that I've had good relationship and I'll continue to keep supporting the pro. So this confidence building relationship is one which is built on transparency, right? You want to actually make sure there is transparency. You're making sure that you're not necessarily cheating, or at least the investor doesn't feel like he's being cheated or shortchanged. You're not necessarily doing questionable business practices. You're essentially coming back to them and saying, is there ways for you to actually help me build value, rather than just saying you're just a provider of capital, right? So I think this relationship building becomes really, really important. And one of the things that I think most entrepreneurs need to really understand is building a business is not short term, it's long term. And the best businesses are the ones that always get value. The best businesses are the ones that always get a premium at an IPO. The best businesses are the ones that also get a premium when they're being acquired. Because when you're being acquired, you're not just being acquired only for the product that you're doing, right? You're being acquired for the people that you have actually got in your team, for the values and the principles that you've actually built that whole business around. So I think as long as they understand that the value creation starts happening with the way you build your business up, and then take those measures to really look at building value over a period of time, then that relationship with the investor also continues to really be fruitful, right? The investor is then supportive. The investor then comes back and says, what can I really help you with? And do whatever they can within the capabilities. But also taking a step back. One of the things that's also important for entrepreneurs is to also try and find the right set of investors for them to actually take money from. Don't take money from anybody that sort of comes and says, I'll give you money. Is that person aligned with the vision that you actually have on what you want to be able to do with your business? Is that person somebody who will support you with all the other things beyond capital? Is this person who understands your industry a little bit and says, okay, I understand your industry a little bit, or I know something in your industry, so I can actually provide you access to markets. I can actually provide some value-added services as well. So I think it's important it's just like, I always go back and give this analogy of marriage, right? Because that's the best example when it comes to looking at startups and investors. You look for the right person that you want to actually marry to, right? Because it's important. And you look for certain qualities. It's the same case here also. Look for those kinds of qualities which are important to you, which will work well for you as a business and as a startup as you grow the business. Will this person really be supportive of you as you're building and growing this business? Because there are ups and downs. And if this person is very supportive, then you can actually make through it and build a very successful enterprise. So that relationship building and making sure you're getting the right set of investors who can actually back you is very, very important. And I think being transparent, of course, you've seen the whole bunch of corporate governance issues that have come up, all of that, right? I think that becomes really important. And I think from the investment perspective, I think we as investors have to be much more proactive. And I think that's something that we are now starting to understand, right? I think for most investors, the investing piece was the sexy part. But actually, in the venture capital world, investing is not the it's the easier part. The tough part is managing the portfolio and making sure I can add value and I can get an exit, right? That's a really tough part, and it's not easy. So if you have to be able to do that, make sure you're investing in the right kind of companies as well as an investor, and then make sure you can actually add that value to actually make these companies grow so that you can actually be able to benefit from that value.
Perfect. Awesome. So, what we have seen over the last few years, okay, so most of the startups are actually focused on aggressive growth, for which they are spending too much. Okay, means in terms of their spending is much higher in terms of the returns that they are getting per rupee spent. Okay, so more or less now the trend is more focused towards becoming startups becoming more sustainable and more profitable. Okay, so there is a term called sustainable profitability that is being focused upon. So what are the tips that you would like to give for startups to be more to achieve more sustainable profitability? And would you be able to give specific examples of startups that have actually transitioned from growth focused strategies to a more profitable model?
See, right from the beginning, I think entrepreneurs and startups and teams have to really focus on capital efficiencies, right? I mean, you have to be in a position where that mindset has to be there. Can I actually every rupee that I'm actually investing or spending, can I get more in value for that rupee that I'm spending, right? So that mindset has to start coming in very early on when you're actually looking at building a business. I have a startup that's doing about 250 crores in revenue, right? 250 crores is not small. Profitable business. How much money they've raised? They've only raised 13 crores. And with only 13 crores, they've gotten to a 250 crore. And that too, of course, this has been over a 6-year time frame. But now they're sort of seeing significant growth. So one is to actually start thinking about being capital efficient. The second is, if you get into the market, especially, D2C kind of brands where there is a fair amount of money that you need to spend on building out your brand, look at partnerships. Look at saying, can I align with certain partners and actually piggyback on them to actually be able to get to a point where I can get product market fit? Can I get to a point where I can be, I can actually start getting to a point where there is brand awareness? And the other thing that I always tell people is, don't ever give anything for free. If it is free, people will expect you to provide this for free, which essentially means that you will not necessarily see value. Because at the moment you do that, you are essentially getting to a point where people don't really value your product. They see it as a convenience. So one is, make sure that you always price it, even if it's a few rupees, a few hundred rupees, make sure there is a value, because only if there is value that they see it, even if you get lesser number of consumers, that consumer number will, sort of grow and expand over a longer period of time. But you actually get to a sustainable growth, like you said, right? Sustainable profitability, because you're starting to see people coming in slowly, but then they actually see the value of the product or the service that you're offering and are willing to pay for it. And those are the kinds of people that you actually want as customers, not the ones that come in and says, well, it's free, I'm buying it. And if it's not free tomorrow, I will not buy it, right? Those are not the kind of customers you want. And those kinds of metrics of the growth in those numbers is not necessarily something that we as investors would really be happy about. So look for those. The second is, just because you're a startup that has gone out and raised money, don't necessarily go out there and start really looking at fancy lifestyles like you're an established business. Be frugal. And I think the frugality is what I really look for, right? And frugality in the way you build your team, frugality in the way you actually market your product, frugality and innovation in the way you actually build the product. All of that becomes really important. And I actually have seen people who have been able to do that, right? Where they'll say, instead of building this, can I use a third-party app and integrate that for the time being till I get to a certain size so I can actually do that, right? Where can I actually then go and partner with somebody else who's offering a complementary technology and take that to the market? So all of this becomes really important. And least but not last is the fact that one of the things that most successful businesses around the world have all been able to do is the ability for them to provide a superior customer experience. So that's one thing I always keep harping on, saying, even if you're charging, even if you're free, but especially if you're charging, make sure the customer experience is really, really superior. The customer should have that wow factor, right? Every time they use your product or your service. Then what happens? They don't really keep coming back and buying, but they go and tell their friends, they go and tell their associates, they go and tell their relatives. And that's what you want. And how does it happen? Only when you provide superior experience. So if you're looking at a sustainable, profitable business that you want to build over a period of time, make sure you're treating your customer well, providing that kind of customer experience, which gradually sort of, transforms and translates into sustainable revenue and sustainable profitability. Classic example, you look at somebody like an Apple, superior customer experience, right? Which is the reason why people go back to Apple products every time, because the customer experience is a wow. Of course, it's expensive, but it's a wow. Same with a whole bunch of products and services that you actually get here in India as well. If you look at some of these D2C brands that have superior customer experience, they make it really wow. And that's what you need to really aim for. And I think that's what I tell everybody. It doesn't matter whether you're in the B2B space or in the B2C space. Superior customer experience is what sets you apart.
Very good. So my last question would be on your future outlook for the startup ecosystem in India. How exactly do you envision the future of India's startup ecosystem beyond this current phase of funding winter?
So I think, I think these are exciting times, and there are some amazing businesses that are being built, right? If you go back and look at history, some of the best businesses around the world were built during challenging times when there was lack of capital, or capital was not necessarily flowing in as easily, or when there were recessionary environment and you were building a business around that. Amazon, a lot of these companies were all built during tough times. And this is one of the best times to build, because you now have the ability to hire people at a much lesser price, because there are a lot of people who are now looking for jobs. So you can actually get them at a lower price. The cost of actually building a product, whether it's technology or whether it's in the B2C space, prices have dropped, right? So you can actually build a product or build products and take it to market much faster. So, you can actually do it in a much more capital efficient manner as well. So with all of those, really good times to really build your business. So I'm excited about the fact that there are people who are still building new businesses. There are still people who are going out and raising capital, but people who are really generally building large scalable businesses. And what is also really exciting is the fact that we're now starting to see a lot more people with significant work experience in the domains that they want to operate in, right? Who really understand pains and challenges in a particular segment and saying, I see that pain and I think I can actually come up with a solution. And so we're starting to see a lot of these kinds of experienced entrepreneurs with domain expertise, but who also have execution capability and who are actually coming together. So from that perspective, excellent times ahead for the ecosystem, both in India and overseas as well. And on top of that, or at least, along with that, the domestic venture capital ecosystem is also continuing to grow. So there are much more funds, there are more capital pools available. There's much more awareness of this asset class amongst HNIs and family offices. So there's a lot more capital, and that will continue to evolve and increase, right? So I think there is more capital that's going to be still available. I mean, all of that is not going to change. So I think we are poised for a lot more exciting times, a lot more growth. I foresee that there will be, in the next 8 to 10 years, at least 100 companies out of India that are going to be really, really large companies that will be known the world over. Just like, people would know of an IKEA, or they would know of an Apple or a Google. There'll be companies out of India that will be both on the B2B side and on the B2C side that people will turn around and says, look at those companies, right? And I see that happening now. And I think that's the reason why I'm so excited about the whole aspect of entrepreneurship and venture capital in India.
Thanks a lot. Thanks a lot for your in-depth details and very, very informative information. That would be really beneficial for the audience. Thanks a lot for it.
Thank you. It was a pleasure, and look forward to staying in touch. And if there's anything I can help with, please do reach out to me.
Sure, sir. Sure. I would definitely.
Thank you.
For more updates from CXO TV, please like and subscribe to our channel.